Welcome to Funding Juicy Solutions. I'm Juice Ortiz, and I'm coming to you from Colorado Springs, Colorado. And in today's episode, I want to review closing costs. Now, closing costs are the cost it's going to take to get into a loan. They typically range between 2 to 5% of the loan amount. So if you're getting an $800,000 loan, you're probably going to be between $16,000 to $45,000 in cost to close the loan. If you're getting a $300,000 loan, you're probably going to be between $6,000 to $15,000. Now, but there's ways to mitigate those costs, such as seller concessions, which I've talked about on another episode. Now, closing costs are a bunch of different costs that add up over the course of your loan application. There's going to be origination charges, and if you're going borrower pay, there will be a broker fee as well as an underwriting fee from the lender. Now, if you're getting any discount points or paying for buy down points, those are going to go in that section as well. So there's usually some type of a MERS, which actually that's from the lender. You'll get a flood certification. Also included in your closing costs is your credit report fee, because it costs money to pull your credit. There's an appraisal fee, which you typically pay for after you go under contract, but that can get recouped in when you go to the closing table. Sometimes there's a third-party processing fee or a tax service fee. But now I want to jump into the title costs, because every title company is going to have their different title fees or identify their title fees differently than other title companies. There will be lender coverage fees, so your title insurance, which covers the lender from anything that could come back from the past of all sorts of different scenarios. That's a whole nother level. In fact, when I get a chance, I'll introduce you to one of the title reps that I like to use here in Colorado Springs. There's usually a closing protection letter that always comes along with every loan. Like I said, a tax certification. Sometimes there's an e-filing fee, a title recording fee, or a wire fee. There's a bunch of fees that used to be on paper and they've switched to wire, but there's also still fees that are associated with paper. Just keep that in mind. I'm just going over the ones that I typically account for with the company that I usually use. There's going to be recording fees and taxes that are associated with the county that you live in. And there's also going to be transfer fees, again, within the county. These are government fees that come up. Also, there will be prepaids. So, if you escrow your taxes together and your insurance together with your principal and interest, so you only have one mortgage payment that pays for everything all together, the lender who is servicing your loan, they have the right to collect a certain amount of insurance and taxes, property taxes, on the front end and reserve that in a escrow account, so that when it comes time for that insurance payment and those property tax payments to be paid, it is sitting there reserved, ready to get paid. Those prepaids get collected at closing. If you separate your taxes and insurance, which is very rare when you're first-time home buyers, some people who have been doing it for a while, they have experience with paying taxes and insurance, especially if you've had your house paid off for quite a while. You're used to paying property taxes and insurance by yourself, so some people elect to pay those by themselves and pay the principal and interest only to the lender. When you escrow those together, the lender gets to collect a certain amount up front. When you don't escrow those together, you pay them by yourself. That will lower the closing costs, because again, keep in mind, closing costs is the money that you have to bring to the table to close the loan. So, although it does include your down payment amount, it also includes other fees associated with the loan, and it also includes potential future insurance and property taxes. Now, property taxes and insurance, I'll go over in another episode, but I hope this gives you an idea of what's going into it And I do want to mention, because I did an episode on seller concessions, when you get seller concessions, that money can be used to cover the closing costs. It can't be used for the down payment, but it can be used to cover those discount points, those buy down points, those title fees, the lender fees, if you're going borrower paid, the broker fee, any of those other monies that are required to close the loan, seller concessions can be used to pay for that. Same as lender credit. Now, I have other episodes that talk about the cost of borrowing money or the cost of credit, and there you can see that if you're above the par rate on your interest rate, oftentimes you get a lender credit and you can use that money to cover closing costs. If you're under that par fee, then you're paying discount points, which you can use seller concessions to help cover, but there's no lender credit because there's a cost to get the interest rate. If you're above the par rate, there's a credit for getting that interest rate. Anyways, I hope this was helpful. In general, keep in mind 2 to 9% will help you get a home loan, whether it's a refinance or a home purchase. My name is Juice Ortiz. Remember, whatever your situation, there's a juicy solution waiting for you. Give me a call or shoot me a text. I would love to talk to you and review your circumstances to see what we can do to help you own your own home or utilize that equity that you already have in your home. We'll talk to you soon.